Hello and welcome to another episode of the UK Dividend Stocks podcast. In today's episode, which is the first one in about a year or something, I thought we could have a look at the FTSE 250 and in particular why it's looking very cheap now relative to some pretty well-established metrics. So, before I start with that, let's have a look at the usual disclaimer, which is that this podcast provides information and education for investors, not financial advice. If you're not sure if an investment is right for you, then you should speak to a regulated financial advisor, which is not me. So, the FTSE 250's price is down about 30% since 2021. That's where we'll start. So, back in 2021, mid-2021, everyone was maybe happy because the pandemic looked like it might be coming to an end. And since then, we've kind of gradually realised that you can't shut off the global economy on and off for a couple of years without causing serious problems. And so those problems have been coming through in various ways over the last year or so. And as a result, share prices are down a lot. There are other factors as well, but that's certainly a major one. So the FTSE 250 is down about 30%, which is, it's a lot. You know, the definition of a bear market is a fall of 20% from a previous peak. So 30% is a pretty significant decline. And in the short term, this is not very pleasant for investors. Nobody likes to see the value of their portfolio down, 10, 20, 30. I've been through a couple of big bear markets where they were down 50%, and it is very, very unpleasant, especially if you don't really understand the difference between the price of your investments and the value of the investments. But anyway, so falling prices are unpleasant, but there are upsides. And the main upside is that lower prices mean that you're getting better value for money when you put your money into the market. So, for example, when the price of food and clothing go down, people are happy. They're happy because if you've got £100 and you want to buy some food and the price of food goes down, you can buy more food for the same amount of money, or you can buy more clothes for the same amount of money, or you could buy the same food and clothes for less money and then spend the rest on something else. So lower prices are generally seen as a good thing. But when it comes to investing, when prices go down, people don't like it because they look at the price and they think that the price of the investment equals the value of the investment. And so they think if the price goes down by 50%, then the value of their investments has gone down by 50%. But that's like thinking that if you're going to go, say, to the sales in January, and there's a pair of jeans that were £100 before the sale, and then they put them on sale, and then they're £50 instead of £100, so the price has gone down by 50%. But then you're sad and you think, oh no, the value of those jeans has gone down. The jeans are not as good as they were before because the price has gone down. I'm not going to buy them now, because they're not as valuable, which obviously would be completely nuts. If it's the same pair of jeans, the intrinsic value of the pair of jeans, which is how long they're going to last, how comfortable they are, how much value you get out of that pair of jeans, is no different. The value of the jeans hasn't changed. What's changed is that the shop has put the price down by 50%. And therefore, now if you go and buy the jeans in the sale, you're going to get more value for your money. Because you for the same £100, you could go and buy 2 pairs of jeans. So you're getting more value for your money. But people don't think that in the stock market. When they see prices go down, they think that's bad. It is slightly more complicated because the value, unlike a pair of jeans, which stays the same if it's the same pair of jeans, the same company's value can go up and down. You can have a really good company that gets a bad CEO and destroys value. But if we park that whole question to one side, because we're not looking at an individual company, we're looking at an index of 250 companies. And if you aggregate value across 250 companies, then typically it would be very unusual for the aggregate value of those 250 companies to go down. So when you're looking at an index, it's a reasonably safe bet that most of the time the value of the index hasn't changed, and what changes instead is just the price. So so when share prices fall, investors who are buying shares should generally be happy, because it means that they can buy more shares with their money. So the FTSE 250 is now cheap relative to its dividend. So where the price has gone down by 30%, that means you could buy more income, more dividends for the same amount of money. So for example, if you were looking to put some money into a saving account, and there was a saving account, one offered an interest rate of 3% and the other one offered an interest rate of 4%, which of those two accounts, all else being equal, would you put your money into? The one with a 3% interest rate or the one with a 4% interest rate? So obviously most people are going to want to get a 4% interest rate instead of a 3% interest rate, because the yield is higher. And so we see exactly the same thing in the stock market, where today the yield on the FTSE 250 is pretty close to 4%. And a year or so ago, it was nearer 3%. And at market peaks, like just before the financial crisis or in the dot-com boom, the yield is nearer to 2%. So, when would you rather invest in the FTSE 250? When the yield is 2% or 3% or 4%? It's pretty obvious. If you're buying effectively the same asset that has the same underlying value, which as a blanket assumption we're going to make about the FTSE 250, because it's an aggregation of 250 companies, and the long run value, i.e. the cash generating potential of those companies, doesn't really change that much, other than that it tends to grow over time, in line with the global economy, more or less. But anyway, would you want to buy effectively the same asset with the 2% yield, a 3% yield, or a 4% yield? It's the same as a savings account. Most people would want to buy when the yield is 4%, and that's today. So there we go. Falling prices is good news, and the FTSE 250 is also cheap relative to its average earnings. So we can look at dividend yield, but you have to remember that the true yield on equities isn't the dividend yield; it's the earnings yield. So to take a savings account analogy again, with a savings account, if it paid a 10% interest rate, you'd be very happy. But if you drew off half of that income, the income that you draw out of the account, that's effectively the dividend. And then the interest that gets reinvested back into the savings account, that's still effectively part of your earnings, but it's reinvested back into the account. So the whole amount, the interest on the interest on a savings account is your earnings. Any portion of that you withdraw is effectively like a dividend, and then the rest of the interest that goes back into the account is just retained earnings, effectively. So what you have to look at is not just the dividend yield, but you also want to look at the earnings yield as well. And so the problem, so the default ratio that most people look at is the price to earnings ratio, but earnings are very volatile. So the price to earnings ratio can be quite misleading. So it's usually a better idea to look at the price relative to the 10-year average earnings. And that's called the CAPE ratio, which is the cyclically adjusted PE. Here's a chart of the FTSE 250, and it shows how the FTSE 250's CAPE ratio has varied over time. So it uses rainbow colorings to show the different bands of whether the CAPE ratio was high, which is red, or medium, which is yellow, or low, which is green. So, for example, we can see that at the peak of the market just before the financial crisis, the CAPE ratio was pretty high. And we can also see that just after the financial crisis, the CAPE ratio was low, which is not a big surprise. The CAPE ratio, the PE ratio is high before at the peak of a boom, and it's low in the depths of a bust. And so if we look back over the last 30 years, the FTSE 250's CAPE ratio has been cheap or very cheap only 3 times, really. There was once was in the dot-com bust, once was in the financial crisis of 2009, and then the third time is today. So today we're looking at the FTSE 250, and from a CAPE point of view, its valuation is as low as it's ever been over the last 30 years, other than in the depths of the financial crisis and in the depths of the dot-com bust. So today's valuations are quite unusual. This is quite an unusual period for the FTSE 250 to have such low valuations. So so CAPE usually stays in a range between about double its long-term average and half its long-term average. So over the last 30 years or so, CAPE has averaged 22, which means the range is between about 11 and 44. And actually, the FTSE 250 hasn't even quite strayed that far from the average. And anyway, so the FTSE 250 today is about 17, which is comfortably below the average of 22, and that's low enough to put it into what I call the very cheap range. I basically break up the range of possible values into buckets, and it's currently in the very cheap bucket, which is only one above the depression level bucket. So valuations are definitely at the very compressed end of the range. But that's good news, because low prices like this usually mean high future returns. When prices are low, investors expect them to fall even lower. But in reality, when prices are low, there's usually a fairly robust short-term recovery, because whatever it is that's depressing investors turns out to be temporary. The economy recovers, sentiment recovers, that raises share prices, which sucks more people into the market, and prices go up, and that brings in more investors, and so on and so on. And so these periods of very depressed valuations tend not to last that long. So in the dot-com bust, the market was depressed, and then it kind of doubled over the next 5 years, and then we had another crash in the financial crisis, and then the FTSE 250 roughly tripled over the next 10 years or so, and then we had the COVID crash, and then there was another rapid recovery, and now we've got the kind of post-pandemic inflation recession crash, or not quite a crash, but a kind of slow grind downwards. And so from these valuation levels, history tells us that we typically get quite a strong rebound. Obviously, in reality, that's not guaranteed. There's no guarantee that the market's going to recover strongly over the next year or two. But history suggests that that's probably the likely outcome. And we've had that kind of recovery many times in many different markets. So overall, I would say that at the current level, the FTSE 250 appears to be both very cheap and very attractively valued. And I think that's all I have to say about that. So I hope you found some of that useful, and I will see you in the next episode. Goodbye.